Okay, well, we have Richard Yetsenga. He's a Group Chief Economist at ANZ Research. Richard, good to have you with us here. Good morning. Thanks very much for your time. You know, I just want to quickly get your sense on this absolute lack of safe haven demand, which is showing up with bonds and U.S. Treasuries. How would you explain it, Richard? It's quite unusual.
Well, I mean, I guess the language of the question is quite strong, absolute lack. I mean, equity markets in general haven't responded all that poorly to what's happened either. I think the fundamental question, is there a global shock of enough significance that you would expect the dollar and the treasury market to be responding substantially? And we shouldn't, of course, gloss over the enormous human cost of what's happening in the Middle East, but the size of the economies is relatively modest. There have been long-standing tensions between these regional economies, so we can't say this has come out of nowhere. It doesn't seem to particularly affect trade. It does affect oil prices, and the oil market has moved. There's a bit of a bid in gold, of course, on the back of it. But I think so far it's not just a US asset market signal. I think the signal from most markets is this is an oil market issue, but really not a global economic problem.
But a big oil issue is a global economic problem, isn't it? I mean,
if it's a big oil issue, oil's up $10 from the lowest levels we've seen in quite a long time. And again, that doesn't look like it's an oil shock. It looks like it's a price adjustment. The oil market perhaps a month ago was adding in an excess supply discount. Now it's adding in potentially a restrained supply premium, but oil is well within the recent range of recent years. Again, it's a price move, but I don't think this is anywhere close to an oil shock.
Richard, that's an interesting take, and it's good to have that perspective that beyond the $10 to $12 increase in price of oil, at least right now, it hasn't damaged too much. Which then brings us back to the other core issue, and that was trade, right? That there is a trade deal now with at least China, and the US seems to be indicating that it could push back the timelines beyond July 9th with trading partners which are negotiating, quote unquote, in good faith. So, what do you think will the market take away from all this? And, do you have a sense on the general direction of equities then?
Look, I think the probability of some 80 trade agreements being reached in 3 or 4 months was always extremely low. So I think the potential for timelines being pushed back from early July is not a surprise. Of course, it is good news that seems to be some of that looks like it's likely to occur on the back of the US recognising that's required, rather than again using that July 9 date to play more brinkmanship. But a handful of countries having their agreements extended obviously doesn't mean that everybody has their agreements extended. And so there's still a lot of water under the bridge. But what we do know is the US administration does seem keen to ensure there's not too much economic or market damage from the trade agreements, and I think that is the most important signal.
Hi, Richard. Good morning. Good to have you on the show. Thanks a lot for joining. And well, let's circle back to India then. India, if we have a supportive RBI out here, they have, pepped the system with a couple of rate cuts. The currency market out here is fairly stable, and we are likely to be one of the fastest growing economies. What is your view on how the Indian economy is shaping up? Best placed, you would say?
Well, you've given quite an optimistic story there. Certainly before the RBI's most recent meeting, maybe you wouldn't have been quite as optimistic, but that monetary injection has sent a very strong signal. And then, of course, we've had some indications from inflation as well that kind of upside surprise seems to have ended, and potentially we're in for some lower tracking in inflation. That's unambiguously good news. And India, as we know, a relatively closed economy, not as open to the global trading system as other economies in the region. And perhaps reading the tea leaves a bit, seems to be in quite a good position with the Trump administration, which again suggests one of the key risks that people are looking at, namely what the relationship with the US, how that relationship develops between any individual economies and what trade agreements are likely to come. India also stands pretty well on that point as well. So I agree with your conclusion. India looks like a very solid story in a global economy that's dealing with quite a few headwinds.
That's good to know. That's music to our ears, Richard, for sure. Just a quick word on China as well. I was just looking at the data that came out this morning. The retail sales numbers were good, but industrial output has been cooling. But now they have a deal, or at least a semblance of a deal with the Americans. So what's the assessment at these present tariffs that are being spoken about? Where does that leave the Chinese economy?
Yeah, China and the US have a framework for an agreement. Obviously, there's a lot of detail to work through, as we've already seen. That detail will matter, particularly around rare earths and some of the other very sector-specific issues, US technology exports, for instance. But we've had some better news. I think China economically, the shifts in the global trading system are an issue for China. Its production sector is heavily reliant on that external demand. So the pickup in retail spending is welcome. It would surprise me if that was sustained at the sort of rates we saw in today's numbers. That doesn't seem consistent with what we're seeing in terms of household behaviour, but also in terms of just the gradual decline in population and the loss of consumers in China, likely to be a drag on consumer spending as well. I think in a world that looks like it's in quite a lot of flux, probably what we can say about China is solid and consistent.
Oh.
All right, Richard, thank you very much for joining us. Appreciate your time here on CNBC TV18. Good conversation and a good perspective as well.